Hey everyone, if you fail to interpret market structure signals accurately, you'll most likely end up trading against the trend and lose many trades. That's why in this video, we'll break down how to understand market structure to identify the direction, key levels, and reversals. Here is the list of topics we are going to go through in this video. If this is something that interests you, make sure to press the like button to show your support and subscribe to our channel if you're new. I'll catch you after the intro and disclaimer. Let's begin with the basics of the price chart, determining the market direction, supply or demand, and who is currently in control. Pinpointing the market direction is typically the initial step when examining a price chart. We aim to recognize the trend and assess whether buyers or sellers are dominating. We always try to trade in the same direction as the dominant side of the market to improve the win rate. How does this system operate? The approach functions through mitigations. When the price mitigates a demand level, demand takes authority over supply. In contrast, when the price mitigates a supply zone, supply takes authority over demand. Picture the price advancing in an uptrend, forming a sequence of higher highs and higher lows. Each time the price breaks structure upward, a demand zone is created. These demand zones stay unmitigated until the price comes back to them, offering a solid chance to follow the trend. But if the price drops below a demand level, creating a change of character, it signals that supply has now taken control over demand and the market has developed valid supply zones. The price continues moving downward, forming fresh supply levels until it reaches the next untouched demand zone. At this moment, there is a battle between supply and demand, and we must wait to see which side prevails. If the price pushes above the supply zone, it means demand is stronger, and price will probably keep trending upward. Conversely, if the price falls below the demand zone, it shows that supply is stronger. This often results in continued downward movement, and the price may head toward the next demand zone where buyers could become active. Again, you should monitor these levels carefully. A clean break and retest can provide solid trade setups, while fake breakouts can trap traders who enter prematurely. Here we have a sequence of higher highs and higher lows indicating that demand is in control. The overall market sentiment is bullish. This means the price is more likely to keep moving upward. The direction will stay bullish, and we will only search for long setups as long as the price remains above the most recent demand zone. So let's observe what unfolds. The market reacts to the demand level but fails to produce a new high because buyers lack strength, and eventually, the price drops below the supply area. At this point, we can say buyers are no longer in control and a reversal is on the horizon. If we consider these points as the origin of the impulsive move that shifted the market structure, then they become our supply zones. From there, the market continues breaking structures to the downside, signaling that supply is in control. Another supply zone forms, and the price approaches the next unmitigated demand area below. This demand zone can serve as an area of interest for buyers to re-enter the market. At this point, there is a struggle between buyers and sellers, and we need to wait and observe the price action to see who gains control. This level can either act as a reversal area for the market or at least cause a short-term correction. It is crucial to keep in mind that we cannot control the market. What we can do is prepare ourselves for the different scenarios that might occur. Ideal and imperfect trends. How to recognize genuine reversals. When the market is in a perfect uptrend and the price continues climbing, it respects demand levels and breaks structures to the upside. In other words, using classical terminology, it forms higher highs and higher lows. Each time a structural point is broken, a fresh demand zone is naturally formed. This break of structure is only confirmed if there is a candle that clearly breaks and closes above the level. Even though a wick above this high shows that buyers managed to push the price beyond it. It also reflects an instant rejection back into the range. This often resembles a liquidity grab where stop losses are triggered for traders who went short due to the previous rejection. If another break happens with a full-bodied candle, it indicates a valid breakout. At that stage, we can identify this level as our latest higher low. As long as the price holds above this level, we stay bullish and focus on long positions. However, if you notice a strong reversal setup, you could consider taking a short trade targeting this demand zone since it still acts as strong support for the price. A change of character happens if we see a break and close below this low. This indicates that the strength of the buyers is now uncertain and the market may shift structure and enter a downtrend phase. The same principle applies to bearish conditions. When the market is in a proper downtrend and the price continues falling, it respects supply areas and breaks structures to the downside. In other words, it forms lower lows and lower highs. Each time the price breaks a structural point to the downside, a new supply area is automatically formed. As long as we stay beneath this swing high, the price remains in a downtrend, and we are only focused on selling this pair. Here's an example. This is the recent movement of the euro-dollar pair on the 1-hour chart. You can see how the price respects lower highs and continues breaking structure levels to the downside, forming a clean downtrend setup. You can clearly spot structure levels, swing highs and lows, and possible trading setups. If you study the price chart and struggle to identify who is in control, it's often better to switch to a different pair. However, the issue is that the market rarely moves this cleanly. In imperfect trending situations, the market might break below higher lows but still continue in the same bullish direction, confusing traders who assume the uptrend has ended. These breaks typically occur to collect liquidity or mitigate fair value gap zones. Let's discuss imperfect trending markets and how to determine direction without getting fooled by fake reversals. In the next section of this video, I'll walk you through an advanced trading approach that helps you differentiate between major and minor swings within the market structure. Here's an example of what an imperfect trending setup might look like. At first glance, it may seem choppy and lack clean direction. But in this video, we're going to share a method that turns this messy line chart into a clear, readable trend. The main idea here is that in these imperfect trends, it's essential to focus on the overall structure instead of getting distracted by every minor break. Many of these small reversals are temporary and may simply aim to trigger stops or collect liquidity from retail participants. The first concept we're going over is how to detect major and minor swings. When is a swing high or swing low considered strong and when is it weak? Hey traders, you've been asking for it, and it's finally here. The 2-month SMC Trading Mastery course drops this November 1st. This isn't just another course, it's a complete system to master smart money concepts, manage risk like a pro, and build consistency in your trades. And here's the crazy part. It's only $500, plus 61% off for pre-bookings before November 1st. Oh, and we're giving away 5 $100,000 funded accounts to our students. Don't wait, click the link, secure your spot, and let's make this the turning point in your trading journey. See you inside. In an uptrend, major swing lows are key zones where break of structure impulses begin. This represents the highest price recently traded in the market after breaking a previous high. So the origin of that impulsive movement becomes our major low. A change of character takes place if the price breaks this exact level to the downside. The other swing lows are treated as minor, and breaking those does not confirm a true reversal. Now here's a key point. We can only label a level as a major swing after a valid break of structure has happened. For example, this low cannot be identified as a major swing low until a proper break of structure occurs. This is the highest price recently traded. So, a break of structure is only confirmed when the price pushes through this level. As stated, only after a valid break of structure can we label a level as a major swing. Therefore, this level is seen as a major swing low while the others are minor. Breaking below a minor swing low also signals weakening bullish momentum. If you find a strong reason, such as a reversal liquidity sweep setup from a higher time frame key level, you could think about taking a short targeting the major swing low. This is because once this level is reached, there is a battle between supply and demand, and we often anticipate a rejection when the price taps that major low. However, trading against the main trend can be risky since it raises the chances of being stopped out, basically going against the flow. Now, let's summarize the bearish scenario. Being able to differentiate between major and minor swings helps you correctly determine market direction and real reversals. After breaking the lowest recently traded price, the starting point of that impulsive move becomes our major high. On the euro-dollar 1-hour chart, we can see 1, 2, and 3 moves breaking below this low, forming a trend. The starting point of this move becomes our major high. As long as the price stays below this level, the market remains in a downtrend. Let's keep identifying major and minor swings. When the price breaks through and forms a new low, we mark the area where that break of structure began as the new major swing. If the price only wicks below the recent low, this is not a valid break of structure and is therefore a minor swing. Breaking above a minor swing does not signal a change of character. A true reversal only happens if we break above the major swing low. We keep spotting major and minor swing lows until we see a confirmed change of character, indicating a reversal and shifting our bias to bullish. This was the first rule for identifying a major swing, the origin of a break of structure. There are two more criteria that help us determine major swings and confirm market direction. Number 2. Fair value gap. A bullish fair value gap indicates a buy-side imbalance where buying pressure heavily exceeds selling pressure. Often due to institutional activity, the demand zone that caused this gap becomes stronger and we expect a reaction when the price revisits this area. From an imbalance perspective, demand zones with fair value gaps are treated as major swings, while those without imbalances are considered minor swings. Breaking below a major swing that created an imbalance marks a notable shift in trading momentum and signals a possible reversal. The same logic applies in bearish conditions. Here we have 3 price examples. The first one does not show a break of structure or an imbalance, so it is labeled as a minor swing. Breaking below this area does not suggest a change in direction or a reversal. The second one is the origin of this breakout but does not include the imbalance, so it is viewed as a major swing but with only 1 star. The third one is the origin of the breakout and has produced an imbalance, making it a major swing with 2 stars. I hope this is not confusing. Up to this point, we've discussed 2 criteria that make a swing point significant and major. Before we move to the third and final criterion, let's review a trading setup. Here we have a major swing low that initiates this break of structure. There is also another swing that caused an imbalance. This level is treated as a strong swing even though it did not create a breakout. When the price returns to this zone, we anticipate a rejection. However, if the price breaks below it, that reflects bearish momentum. This situation often appears when the price taps into a higher time frame key level. Now, we can take short entries in this inverse fair value gap zone, targeting the major swing low because it continues to serve as strong support for the price. Now let's cover the third and final criterion that helps us identify a major swing: the distance covered by the price. Look at this example here. The most recent move has created an imbalance and broken the structure level to the downside. By definition, it is a major swing low. Does breaking above this high indicate a valid change of character? If your answer is no, can you identify what is wrong in this scenario? The issue with this move is that it does not have enough distance covered by the price. If you measure the previous impulsive movement, it is over 60 pips, while the latest one is only 20. Therefore, this high does not qualify as a major swing, and breaking above it does not confirm a valid change of character. So here is an important point. To classify a level as a major swing, the distance it moved must be at least half of the prior impulsive move. This is our third and final rule for identifying major swing points. Now look at these examples. In the first one, none of the criteria we mentioned are satisfied, so it is considered a minor swing point. In the second scenario, we have a break of structure and a notable distance covered by the price, but there is no imbalance. As a result, it is considered a major swing with 2 out of 3 criteria satisfied. Here we have imbalance and a proper distance but no valid break of structure. So, this is also treated as a major swing point with 2 stars. In the last example, this swing has formed imbalance, broken structure, and shown sufficient distance. Therefore, it is a major swing point with 3 stars. Breaking below this low represents a valid change of character, a complete shift in market direction and momentum, or however you prefer to describe it. Up to this point, we have covered how to identify major swings and valid changes of character. I want to mention that there are 2 exceptional situations that make a change of character invalid. These 2 cases are liquidity sweep and fair value gap mitigation concepts. This might seem complex at first, but it will become clear shortly. Here we have a major swing low that initiated this breakout. Breaking below this level indicates a valid change of character. However, if you look to the left, you'll see that this level is located in a key liquidity zone. Many traders previously opened long positions at this level, placing their stops beneath it, which means there is a large pool of liquidity below. To hunt these stop losses, smart money often drives the price lower to capture the liquidity and then continues in the same bullish direction. Here is a key point. When a major swing is positioned in an important liquidity area, breaking through that level is viewed as a liquidity grab and does not necessarily confirm a coming reversal. Keep in mind that in this situation, we cannot label this break as a valid change of character. If the price returns inside the range, it gives a strong opportunity to enter a long position. The overall direction is still bullish. The smart money has taken the sell side liquidity and the next target would be the buy side liquidity. As smart money traders, we aim to enter a trade after the stop losses have been taken out. The liquidity sweep was the first concept in this topic. There is also another concept that can invalidate the change of character, which is the mitigation of fair value gaps. We all know that a fair value gap refers to the empty space that forms between the wicks of 3 consecutive candles on the price chart. Regardless of whether the candles are bullish or bearish, when the upper wick of the first candle does not overlap with the lower wick of the third candle, that zone is marked as a fair value gap. If you follow smart money concepts, identifying fair value gaps should be one of the very first steps when you open your chart. But why is it so important? Besides the reasons discussed earlier, price often revisits these zones to fill them because they represent inefficiencies in price movement. These inefficiencies, also called imbalances, usually point to a lack of liquidity in that area. Major institutions tend to fill these gaps to rebalance orders and create smoother price action. This helps the market continue in a more stable and efficient manner. As a result, fair value gaps often act like magnets for price before it resumes its direction. Intraday timeframes are ideal for spotting fair value gaps. Intraday refers to charts with time periods less than a day, such as the 4-hour, 1-hour, or lower. Fair value gaps can be applied to any tradable asset, but they work best on instruments with high trading volume where a large number of participants are active. This includes forex pairs, stocks, cryptocurrencies, and futures. Now, let me show you how mitigating a fair value gap can invalidate a change of character. If we go back to the previous example and look at the left side of the chart, you'll notice an unmitigated fair value gap located just below the major swing. In situations like this, price will typically pull back to that fair value gap area to restore balance. This kind of move does not indicate a genuine reversal. That's why it's important to examine the left side of the structure to determine whether price is simply filling the gap or if there's an actual shift in market sentiment. Doing so helps you avoid false signals and keeps you trading in line with the broader market direction. Before we wrap up, remember that recognizing fair value gaps and understanding market structure shifts are powerful tools, but mastering smart money concepts takes time and consistent practice. No strategy is perfect. However, by deepening your knowledge and combining these concepts with proper risk management, you can greatly increase your trading edge. Stay disciplined, keep analyzing your charts, and follow where smart money leads. That's it for today. Traders, thanks for watching this video. So traders, I hope this video was valuable for you. If it was, make sure to hit the like button to show your support. And if you're new to the channel, think about subscribing as we share a lot of advanced concepts. Catch you in the next episode.